Welcome back. You're watching London Eye. My guest on the show today is Jim O'Neill, talking about whether the BRICS story is just going through a temporary lull and will bounce back, and why India is at the bottom of the list, according to him, in the BRICS story. A lot of people in India have taken quite a bit of heart from the fact that crude started collapsing, gold collapsed 15% in 2 days, because these things are good for us, but India still remains bottom of the barrel for you in terms of the BRICS ranking. Why are you not optimistic on the margin that falling commodities might help India's macro out?
I do think falling commodity prices is a really good thing for India, so in that sense it's very important that you remind me of that. The reason why I say that in terms of ranking of markets, because India's on a forward PE actually the most expensive, and the other three look really cheap. Even though India's struggled itself, it hasn't really done poorly like the other three markets. And then as it relates to the economics, we have an India that's growing in a 5 to 6% vicinity against the background of an India that if it really got its act together, could quite easily grow by 10% given its demographics. So some of my caution about India relates to the fact that the policymakers seem to be in almost constant gridlock in trying to unleash supply-side reforms and productivity changes which will allow the Indian economy to grow that its long-term potential, to me, suggests it could do.
Do you sense any major disappointment when you speak to your investors about India? Do they say that, we thought so much about this place, but they seem to be missing the boat?
Well, I'd say from a lot of Western investors, it's almost a bit more cynical to say, told you so, that many people, particularly I always find it quite amusing, people that have visited India for the first time, and particularly Mumbai, are always shocked about what Mumbai is like as a place visually, and so it immediately scares them off from investing and the whole experience of using Indian infrastructure. And so quite a lot of investors often get dragged into investing into India by default, really, and the fact it did so well dragged money in. So the fact that the Indian market has stalled and the Indian economy is slower is actually got a bit of a resigned sort of I told you so view amongst many investors I speak to. And I link to what I said earlier. A lot of people look at what goes on and say, India needs a lot more decisive government and to try and be more ambitious in terms of introducing economic reforms, then it'll do better. And I have to say on that, I agree with them.
What's your view on equities globally this year? Because there seems to be a bit of disbelief that markets have done so well. These corrections are proving to be more and more elusive. Do you think the bears or the naysayers will continue to be frustrated this year?
Well, I've been essentially bullish ever since 2009, and I never believed the decline we saw on the back of the Great Recession in 2008 would last that long, because equities are really cheap. I spent a lot of time looking at something I call the global equity risk premium, which is the so-called risk-free rates over government bonds, and it's really high. And when it's really high, it's a good time to invest. And if you look today as to why it's high, it's not only because bond yields are low, it's also because dividend yields are very high, and partly due to the indirect consequences of China. Global growth continues to be okay, even despite some of the challenges in the West. Then if you add on top of all of that the extraordinary generosity of Western central bank monetary policy, it doesn't surprise me at all that equities are doing well, and I think it will, broadly speaking, continue.
What's the biggest risk this year, you think?
I think the biggest risk this year, ironically, would probably be if the US economy starts to recover sharply from here, particularly as many people now think it's slowing, so much so that the Federal Reserve Board starts to scale back on some of its asset purchases, and people start focusing on so-called exit strategies. I think that would be an end of some of the liquidity benefit to markets, and that probably would be the biggest risk. I think a lot of the other things that people talk about, the European crisis, fears of a China hard landing, Middle East, these are things that people have all sort of learnt to live with to some extent. So probably the biggest risk would be an early exit from monetary policy by the Fed.
But from the data that you've been receiving or reading so far, would you say that's a high probability outcome, or that phase is still a bit away?
I'd say that phase, this is why the markets are doing so well, that phase looks quite a way off. Even though we've had some softening of growth in the States, it's not been much, but the most important story is that inflation has been so low that the Federal Reserve Board is making it very clear that they plan to stick with this policy and do not dismiss the possibility of even more easing as we go forward. And so I think that the notion of them exiting right now seems quite a way off. But I'd put that as the biggest risk for the year, though.
What would you buy, though, if you were bullish on equities right now? Is it just prudent to be in US and Japan, which are the outperforming markets, or is there better value elsewhere?
I think there is much better value elsewhere. The US rally has been so big. There's not actually a lot of value there. The US, you've got momentum and support of policy, but no value. The big value play is Europe and the BRICS. And I think for people that really want to buy and hold stocks for a bit longer and really focus on the underlying value and longer term, my guess is the better places to invest now are Europe and the BRICS, although they might not give as steady a performance in the near term as the US and Japan, but that's where the real opportunities are. It's very interesting in that regard, by the way, that the past 2 weeks the European markets have started to rally sharply on the belief that we're shifting away from some of this austerity, and of course the ECB reduced interest rates last week. So I think there's a lot of positive forces out there for many markets, but the ones I think on a 12-month to longer basis that will perform the best will be Europe and the BRICS.
Why are commodities doing so poorly, though? I mean, if the global growth outlook is not too bad, then why are things like copper, crude beginning to collapse? Is there a note of dissonance out there?
Well, I think there's two things. I think you have to look at some commodities for different reasons, as we discussed earlier. I think if you look at crude, there's a lot of big supply side changes going on, especially with shale oil and shale gas. I think with copper, some of that is a little bit surprising, but I'm guessing it relates to many people starting to acknowledge that China is not going to grow anywhere near 10% anymore, and probably between 7 and 8. And perhaps people have built up too high expectations of China growing close to 10% for too long. So that would be my hunch as to why copper is so soft.
So do you see this as a grind up kind of a global equity phase, or are you predicting in the next couple of years return to a roaring bull market?
I think it's going to be a time till we get a return to a roaring bull market. The scars of 2008 are still very deep, and ironically, despite the rally, people don't like equities. So people buy equities by default, and if you look within the markets, particularly within the US market, defensives have been leading the rally, and that's a sign that people don't really trust the equity market, and they're doing it partly because there's no return elsewhere. But I think gradually, as equity markets keep on performing, people will start to rediscover that it is an asset class that has some underlying attributes and, of course, value.
Jim, a pleasure. Thank you very much for your time today.
Thanks for having me on.